Panel, welcome to the big question. Gene Fama, let me start with you. You came up with this efficient market hypothesis, so tell us briefly, what is it?
Well, it's a very simple statement that prices reflect all available information. Testing that hypothesis turns out to be more difficult, but it's a simple hypothesis in principle.
Okay. Richard Thaler, do you agree that market prices reflect all available information?
Well, like Gene says, it's easier to say than to test. And I like to distinguish two aspects of it. One is whether you can beat the market. That's the one most people are most interested in. And the other is whether prices are correct. So if prices reflect all information, then they should land on the right price. And we can separate those two questions because they're different.
Okay, but the basic premise about the containing the information is something you don't agree with then, it sounds like?
It's almost impossible to test that hypothesis, except through the two questions that I've asked. Can you beat the market? And are prices right? Okay.
Is that right, Gene Fama? If you say that prices reflect all available information, it necessarily means that a price is right at any particular point in time?
That's the statement of the hypothesis, but it's a model. It's not completely true. No models are completely true. They're approximations to the world. The question is, for what purposes are they a good approximation? As far as I'm concerned, they're a good approximation from almost every purpose. I don't know any investors who shouldn't behave as if markets are efficient, for example. And there are all kinds of tests with respect to the response of prices to specific kinds of information, in which the hypothesis that prices adjust quickly to information looks very good. There are others where it looks less good. So it's a model. It's not entirely always true, but it's a good working model for most practical uses.
Okay, is that right? Is it a good working model?
Well, again, I think for the first part, can you beat the market? I think Gene and I are in virtually complete agreement, which is that's a good working hypothesis for any investor.
Does that mean you should assume, any individual investor should assume that markets are efficient?
Behave as if would be the way you'd put it.
Behave as if.
Well, yeah, certainly there's evidence going back to the thesis of Mike Jensen, who was, I guess, maybe one of Gene's first students,
right,
who was around at the same time, who did a thesis on whether mutual funds, on average, beat their benchmarks, and after you account for their fees, they don't. That was in the 60s. It's been updated a zillion times, and you can quibble about exactly how to do it, but that's approximately true. So just investing based on fees is not a dumb thing to do, regardless of the nuances that Gene and I might get into.
Okay, but you talked earlier about in some cases, the model works, in other cases it works less well. And in your book, Richard Thaler, you talk about the 1987 crash, Black Monday, and you give that as an example of how prices are not right. The efficient markets don't really work. You say if prices are too variable, they're in some sense wrong. It's hard to argue the price at the close of trading on Thursday, October 15th, and the price at the close of trading the following Monday, more than 25% lower, can both be rational measures of intrinsic value, given the absence of news. But isn't the idea that efficient markets are supposed to be unpredictable?
Yes, but unpredictable doesn't mean rational. So, I have a 2-year-old granddaughter who runs around like crazy, and I defy anyone to use a rational model to predict what she's going to do next. So she will be unpredictable, but her behavior isn't well captured by a model of maximizing anything other than whatever she calls fun.
So does the market behave in the same way as your granddaughter?
Well, sometimes. I don't think anyone thinks that the value of the world economy fell 25% that day. Nothing happened.
So if markets were efficient, there would be a certain bounded level of volatility So
well, in the absence, so it's not a day when World War III was declared.
But it was a time when people were talking about perhaps an oncoming recession, which turned out not to happen. So, on hindsight, this was a big mistake, but it needn't have been. So, in hindsight, every price is wrong.
Yeah, but
that's 2020 hindsight.
That's 2020 hindsight, and but what I would say is merely the big fluctuations that entire week. Two of the biggest up days in history occurred that week, and three of the biggest down days. And nothing was happening other than the fact that people were talking about how markets are going up and down like crazy all over the world. So that's one indirect way that we can measure market efficiency. This was essentially the approach that was pioneered by Bob Shiller, who Gene shared the Nobel Prize with. And his argument was prices fluctuate too much to be explained by a rational process.
Right, and Gene Fama, is that right? That when there's a certain level at which prices just fluctuate too much?
Well, there's a test for that, and the test says that when we look at longer periods of time, the variance of the price changes should not grow like the length of the time period. If there is all of this temporary variation in prices, that's not rational, and in fact, that test does not indicate that there's temporary variation in prices. So you've got to kind of come up with a different test. Shiller's model was based on the proposition that there's no variation through time in expected returns. But we know there is a ton of variation in expected returns. So that kind of branch of testing people lost interest in because you really can't come to any conclusions. A straight test of whether there's temporary variation in prices says no, there isn't. You can't identify it. And another test, which would be, is there too much variation in expected returns to be attributed to rational behavior? Well, now you have to define what you mean by that, and that's terribly difficult.
But is your argument then that investors are constantly changing their view of the expected future value of the shares?
My view is that risk aversion moves dramatically through time. And in particular, it's very high during bad periods, and it's lower during good periods, and that affects the pricing of assets and then the expected returns you expect.
And so every time there's a stock market crash, people come to you, or they rubbish the idea of efficient markets and point to this massive volatility and say, doesn't that prove that efficient markets are wrong? And
it doesn't prove that at all.
What it proves is what? Is that risk changes a lot very quickly?
Well, and information changes a lot through time.
Dick Thaler, let me turn to you. Bubbles. Gene Fama famously does not allow the use of the word bubbles, but I'm going to use it. Do bubbles exist? How do we define bubbles?
Well, I think it's hard to say. I'm going to present two examples, one of which is, I think, more convincing than the other. The first one is I have a graph that I think you'll show the viewers. It was produced by Gene's son-in-law, John Cochran. And it's a graph of house prices over a very long period of time in the U.S. And what it shows is that for a long period of time, house prices were roughly 20 times rental prices. And then starting around 2000, they go up. Depending on which measure you use, they go up a lot or they go up really a lot. And then they go back down after the financial crisis. Now, I can't use this graph to convince Gene that markets are inefficient.
True. Because the graph stops too soon.
Well, yeah, but we're not going to live long enough to.
No. I mean, if you continue the graph, it goes back to the peak.
Well, but
So what's the bubble? The down, the up, the subsequent down?
Well, okay. So once again, we're in agreement, which is that studying data like this, it's impossible to know for sure whether something's a bubble. There are hints in that graph that prices seem to have diverged from a level that had existed for a very long time. They went up and then they went down. Was this because of irrational exuberance? Alan Greenspan's phrase. What we do know is that in the markets like Vegas and Scottsdale and South Florida, where prices were going up the most, expectations of future price appreciation were also the highest. And that could be rational, but I'm skeptical of that. And of course, in hindsight, it was wrong. But let me present another example, which is amusing at least. This is, have I told you about this one? The Cuba Fund?
No.
Okay, this is good. So there's a closed-end mutual fund that happens to have the ticker symbol CUBA. Now, closed-end funds have been studied for many years. They're a special kind of mutual fund where the shares trade in markets and the price of the shares can deviate from the value of the assets that they own. So this particular fund, although it has a ticker symbol Cuba, of course cannot invest in Cuba. A, that would be illegal, and B, there are no securities. So its holdings of Cuba are zero. And for many years, it traded at a discount of about 10 to 15% of net asset value, meaning that you could buy $100 worth of their assets for $85 to $90, which is a good bargain. Then, if we look at the chart, all of a sudden, one day, the price skyrockets and it sells for a 70% premium. And you can probably guess what happened. That was the day that President Obama announced his intention to relax relations with Cuba. So a bunch of securities you could buy for $90 on one day, it costs you $170 the next day. Now that I call a bubble. And unlike the first case where Gene and I could argue forever as to whether those home prices were rational or irrational, I'm pretty sure Gene doesn't think that it would be smart to pay $170 for $100 worth of cruise ship lines and Mexican companies. And all through this period, there was no change in the value of their assets. So it's not like the market was anticipating some boom in the Caribbean. This is just a mistake.
Okay. Gene Fama, this is an anomaly, but it's also a bubble in your terminology.
Both.
Well, it's a one-day bubble.
No. It goes up and then it takes a year
To come back.
to come back.
Well, it drops most of that 170 the next.
Well, I mean, a few months later, it's still...
Anyway, it's an anecdote, not a,
yeah.
there's a difference between anecdotes and evidence, right?
Okay, so